So we're going to talk about interest rate averaging and what's the best way to structure your mortgages so that you're not going to get stuck on high rates for a long period of time, and then you're also not going to get caught out selecting a 1 year rate and then the next year the rates have skyrocketed and you're going to be exposed to that big change. So a lot of people get confused. Should I pick 1 year? Should I pick 2 years? Should I pick 3 year rate? How should I structure my mortgages? And how do I make sure I'm always getting the lowest rates? And so general best practice is called interest rate averaging. And so what we get is less risk, more reward, and what we're trying to do is measure against having some certainty and accepting there's going to be a little bit of uncertainty. And if I said to you, hey, look, let's pick a 1 year rate, let's go for 4.1%, and then next year, after that expires, it's up to 6 or 7%, what's going to happen is your interest rate expenses are going to almost double. So that's not going to be a fun time. And what we're trying to do is split that up so that you don't have the uncertainty of not knowing what the rates are and having unexpected costs, but you got the benefit of having the lower rates for a period of time. And so this split is called interest rate averaging, and just the example we're going to look at today is 600,000 of lending, and we're going to put some on 1 year, some on 2 year, and some on 3 year. And so we're going to put 200,000 for on each term. So we're going to break it down. So this is 2018, 2019, 2020. And so if you took your 600,000 and you put all of it on a 3 year 4.7 rate, this 200,000 of lending excuse me, would be 9,400 per year for this 200,000 of lending. And if you did that for three years for the all 600,000, so what that means is if you fix all of your 600,000 on a 3 year 4.7% rate, it's going to cost you $28,200 in interest expense annually. So this is certainty of 3 years on 4.7%. But you say to me, hey, look, I've seen this 4.1% rate, I'd like to take advantage of that. So what we'd say is, all right, let's split your 600 into 3 periods, 3 portions. 200K on 3 year, 200K on 2 year, and 200K on 4.1% for 1 year. And so what does that look like? Well, in 2018, your interest expense is going to be 9,400 for the 200K on the 3 year portion, 8,600 for the 4.3% 2 year portion of 200, and then that 4.1% 200K is 8,200. And so what does this mean? Your first year, you're only going to pay 26,200. And so instead of paying 28,000, pay 26,000. So in your first year, just splitting the mortgage up, you're going to save $2,000, and you can put that money into your principal repayments, or go on holiday or spend it however you want. Now, the certainty of having the 3 years does mean it costs you more money, and that uncertainty of picking all of this 1 year rate means you don't know what you're going to have to be faced with in year 2 and year 3. And if you went for all 2 years, you wouldn't know what's going to be in year 3. But the interesting thing to keep in mind is, let's say this year 1 rolls over, and now you've got another 200K portion, and you'll fix it for 1 or 2 years. This would have to be, even if this 1 year rate was 4.7%, then this is going to be 9,400, and you add these up, you're still going to save $800. So you can see that even if the 1 year interest rate spikes quite a bit, that you're still going to save money doing interest rate averaging. And there's a couple of different benefits. Firstly, obviously this annual savings and the protection of not being exposed to massive swings in interest rate changes. But also what it means is, so you fix this again for another 1 or 2 years, and when this one expires, you fix it for another 1 year. What happens is everything is probably going to come up to be due at the same time after 3 years, and it means that you can go and get another cashback if you're open to changing banks. So cashback at the moment for 600,000 might be, let's say 4,500, and by having it all come off at the same time, that means the break fees are going to be 0. Well, it might be a discharge fee or something, but doing the strategy gives you good flexibility, and what it means is, if we have a look at this graph quickly, instead of having big swings in rates every 3 years and it's unpredictable, what we're trying to do is save money every year by having small portions coming up instead of having a big portion fixed for a long period of time. And making these little small increments makes it much easier to get your top-ups approved, and it gives you more negotiation power, because it means that less of your mortgage is going to be liable for break fees, and you get to talk to your mortgage advisor or banker a little bit more often, which, despite the frustrations, is actually probably an advantage. So hopefully I've explained interest rate averaging well. I'll try and summarize the points below.